the recession canceled? Well, if you listen to the mainstream financial media, then it would seem so. The stock market is rallying and everybody's pouring into treasuries thinking, hey, things are great from here on out. But the majority of the fundamental data about the economy is against this consensus. And in this video, we're going to go through all of the things that you need to know about the recession, the historic economic pain that is coming in 2024. First on the list is bank CEOs selling their shares. We have Jamie Dimon selling his shares of Chase, and as of now, he's selling 1 million shares. But it doesn't stop there. We have the chief risk officer of SoFi, who recently sold a couple $1 million worth of shares. And we also have the bank president selling 152,000 shares. Now, you may not be aware, but overall, financial companies are not doing too well right now. Not a great indicator of economic health. For instance, this is the chart of Citigroup, down and to the right. Capital One, down and to the right. Charles Schwab, down and to the right. Bank of America, down and to the right. Citizens Financial Group, down and to the right. You get the point. But speaking of that last one, Citizens Financial Group, that brings up the fact that we are starting to see a new round of bank failures. A small bank carrying the same name, Citizens Bank in Iowa, just recently failed, bringing it to a total of 6 bank failures so far for the year of 2023. This is likely a sign that more bank failures are to come, not with the big boys who have treasuries, because as you know, if a bank has losses with treasuries, the Federal Reserve will bail them out through their BTFP, the Bank Term Funding Program. But a lot of these little banks like Citizens Bank have losses on assets that they cannot get bailed out by the Fed with. And a lot of these with regional banks are going to be commercial real estate loans, with commercial real estate massively underwater, especially with office space staying empty. We have a bloodbath coming in the next year as most of these loans are maturing and will need to roll over while the assets are underwater. Now, at this point, you might be thinking, well, just that alone, and we're nowhere near close to being done here, just that alone might cause the Federal Reserve to pivot, lower interest rates, restart QE, bail out the economy. But that may not be the savior you think it is. Consider the fact that every time the Federal Reserve lowers the federal funds rate because of economic pain, a recession quickly follows. In 1989, the Federal Reserve started to lower interest rates and a recession started in 90. In 2000, the Federal Reserve started to raise interest rates and a recession started in 2001. In 2007, the Fed began to lower interest rates and the recession started in 2007. In 19, the Federal Reserve started to lower interest rates. The recession began in 2020, and the same thing will happen this time. If there's enough economic pain that happens right now that forces the Fed to pivot and lower interest rates, it's because a recession is on the way. But it's not just the banks and it's not just the Fed we have to worry about. We have to take a look at our household balances. First of all, we have a brand new total of household debt coming in at a whopping $17.29 trillion. And a staggering $4.8 trillion of that is non-housing debt. Breaking down the non-housing debt, we see student loans are up to $1.6 trillion, credit cards are $1.08 trillion, and auto loans are almost $1.6 trillion. In fact, the growth in credit card debt of $150 billion from the year before is the largest year-over-year increase since the Fed started tracking that data all the way back in 1999. But on top of that, it's not just the large balances, because if the large balances were all sitting at 0%, then American households would be fine for now. But it's not even that. Interest rates on credit cards are exceeding 20% on average. This means most American households are carrying a credit card balance and paying 20% interest or more. Because of this, it's no surprise that delinquencies on credit cards are skyrocketing right now. And obviously, American households have more than credit card debt. They've got auto loans, they've got their mortgages, and interest rates are rising on everything, which just got to the point where interest payments on American households have surpassed $500 billion for the first time. Now, if incomes were growing rapidly, then none of that would be a problem. But incomes have not kept up with inflation. In fact, many people are working multiple jobs now just to make ends meet. There are 2 job surveys that are done. One of them goes to companies and asks them how many employees they have. that employment number is showing growth, meaning there are more jobs taking place. But when they do the household survey, meaning asking people if they're employed or not, and asking people how many jobs they have, it's showing that most of that job growth is just people working multiple jobs. And even that may not be a problem, except for the fact that we are starting to see unemployment move above its 24-month moving average. And according to Tavi Costa of Crescat Capital, every time this happens, we see the unemployment rate skyrocket subsequently. So households are in a big, huge pickle right now. More debt than they've ever had before at higher interest rates than they've ever had before, with growing delinquencies at a rate that hasn't happened before. And we're about to start seeing unemployment move higher. Not a good position. The next moment, I'd like to share with you about a very important company who is sponsoring today's video, Monetary Metals. The reason why Monetary Metals is doing something so revolutionary goes all the way back to when FDR outlawed gold ownership with Executive Order 6102. What a lot of people don't know about this gold confiscation was that it also outlawed the gold clause that was very common in debt contracts, which allowed people to get their debt paid back to them in gold if they chose. Fast forward from there to 1971, when the US left the gold standard for good, there's no longer any reason to keep this law in place. But what even fewer people are aware of is that this law was actually repealed, which meant that it became legal to denominate debt contracts in gold yet again. Now, for the longest time, I was not aware that this was legal in the United States, let alone that there was any company out there actually doing it. However, when I discovered Monetary Metals, I realized this is exactly what they're doing, and nobody else is. They have created a way for you to get on your own personal gold standard by paying you a yield that is denominated in gold, it's priced in gold, and it is paid in gold. They have multiple offerings like leases that pay between 2 and 5% and bonds that have paid up to 19%. Now, just to be clear, this means that if you start off with 100 ounces of gold at 4%, then you end the year with 104 ounces of gold. The yield is denominated and paid in gold, regardless of what the price of gold does. Your gold is actually growing. Now, I have spent quite a bit of time over the last 2 years now researching how this company does what they do. I've gotten to know the team, and as a result, I've not only become a customer of the company myself, I use the products, but I've also invested into the company personally. Monetary Metals is doing something truly unique, revolutionary, by paying you a yield on your gold, priced in gold, and paid in gold. And I highly recommend and encourage you to click on the link in the description below and open up an account today. But it's not just the bank CEOs dumping their shares, and it's not just banks starting to fail, and it's not just the Fed's problem with being in between a rock and a hard place, and it's not just households having too much debt at rising interest rates with unemployment on around the corner. It's also a problem the government is facing right now. The total debt to GDP right now is about 120%. To put this into an individual example, this is a negative net worth. If you add up all of your assets and all of your debt is 120% the size of all of your assets. Now, the United States has been here before, but that was during World War II, which meant that once the war ended, all the soldiers came home, production ramped up, all the waste and destruction stopped, and most importantly, the government spending and borrowing stopped. The debt to GDP ratio recovered swiftly. But in fact, we don't have a major world war that we are fighting right now. We just have out of control government spending. And that spending has ballooned a national debt to above $33 trillion. Only 10 years ago, the national debt was under $17 trillion. 10 years before that, it was even less than half of that. And this trend continues for decades, meaning that in 10 years from now, by the year 2033, conservatively, the national debt will be $66 trillion. Now, you might think just that raw number is no big deal, but consider the fact that interest rates are higher than they've been in decades, which means that every time they have to pay back a dollar that matures at 2% or 3%, they're borrowing a new dollar at 5% and soon will be 6%. And that's just maintaining the debt. They're adding to it at a staggering pace of $1.7 trillion just last year. A year, by the way, in which there was no recession. What do you think tax revenues do when a recession hits? they drop, which is already happening, by the way, with tax revenues down 9% last year compared to the prior, which means the government's going to have to borrow even more, again, just to maintain. There's a reason why the interest payments alone on the government debt are quickly becoming the largest line item on the budget with this hockey stick looking chart, which is now over $1 trillion, and by the end of 2024 will be $1.2 trillion. That's again just the interest on the national debt. To put that into perspective, that's almost the entire size of the entire national deficit just to pay the interest. And the storm hasn't even hit yet. But it's not just bank CEOs dumping their stocks. It's not just bank stocks and financial sector in general doing poorly. It's not just a restart of more bank failures. It's not just the fact that if the Fed pivots, that's a sign of even worse pain to come. It's not just the issues with households having more debt at higher interest rates and growing delinquencies and unemployment around the corner. And it's not just the fact that the government is a snake eating itself by its own tail, borrowing more money just to pay off the old debt at higher interest rates, which means they have to borrow more just to pay for the current amount they're borrowing, driving interest rates sky high for everybody. On top of all of that, the Federal Reserve itself is in between a rock and a hard place. Of their own making, of course, but they're there nonetheless. If the Federal Reserve sees too much economic pain coming, then they have the choice to pivot, lower interest rates, restart QE. But guess what happens then to inflation? It reignites. Remember what happened in the 70s? Every time the Federal Reserve decided to cut rates, it reignited inflation and caused the problem to come back that they had to raise rates even higher the next time around. We're in the same evolving pattern right now with the Fed seemingly coming in on a soft landing, preparing for rates to get cut because we are turning the corner and they have almost beat inflation. But what happens if inflation is still at 3 or 4% by early 2024, mid 2024, when the recession hits hard? Then they'll have to choose between saving or rescuing the economy from pain or stopping inflation. Well, they have two mandates given to them by Congress. These are their jobs that they are legally required to do. One of them is to maintain stable prices. The other one is to maintain maximum employment. Those two things will be at odds with each other come 2024. If they opt to make things easier for maximum employment, it will reignite inflation. Instead, if they opt to try and continue to fight inflation, that will make the economic pain and unemployment situation much worse. So what will they do? I am not sharing all this with you as a doom and gloom. I don't want anybody to come away from this thinking there's no hope, it's utter collapse, we're gonna have a Great Depression that'll last forever that we'll never escape from. That is not what I'm saying at all. Every generation has had their share of economic crises that we've been able to pull through. And even if the nation goes in the wrong direction, there are still opportunities to protect your wealth and make more as an individual. The only way you can do that though is to be prepared for it and take advantage of it when it starts. As Warren Buffett says, you have to buy when there's blood in the streets, even if it's your own. But in order to do that, you have to actually be able to buy. If you're sitting there in a 60-40 portfolio or fully invested in unhedged passive index funds, you're going down with the ship. Modern portfolio theory is dead. The 60-40 portfolio is dead. Passive index investing is a bubble. Blindly throwing money and burying your head in the sand, blindly throwing your money in the same 1,500 stocks that everybody else in the universe invests in means that it'll go up if everybody else is buying, but it'll go down hard when everybody else is selling because you all own the same thing. The only investing is active investing, looking well into your investments, having a high degree of certainty that you are buying value, hedging your portfolio in a cost-effective way so you're not bleeding and you get to profit or at least not lose when things collapse. The storm is coming. Prepare your lifeboat now. And if you don't know how to do any of that, don't worry. That's exactly what I created Heresy Financial University for, so I can teach active investors how to protect their wealth and actually increase your returns while decreasing your risk. It's $99 a month. You get access to my entire library of training material on things like fundamental analysis, portfolio allocation, hedging, and much, much more. We do monthly live streams with a Q&A, and it's $99 a month, but the price is going up for new members in January. So if you join between now and the end of the year, you lock your price in for good. Your price will never go up. But starting at the end of this year, I will be raising the price. It will no longer be $99 ever again. Link is below. As always, thanks so much for watching. Have a great day.